Good afternoon, everybody. Welcome to TraderMerlin Show for your Tuesday afternoon edition. It's Trivia Tuesday. It's Taco Tuesday. All you guys spent hours today working on my trivia round. It's going to be a good one tonight. Get that already. I guess the real trivia question is, where the heck is all this great data coming from? If you guys saw the announcement we talked about on yesterday's show, and I said, man, if we get anything below that 3.2 expectation, this market's going to rip to the upside because the expectations are the Fed's going to pause and it'll all be good. Well, we came out at 3.0, no change month over month, which is a pretty impressive feat. So let's talk about this new CPI data. And yeah, the AI did a decent job, made my nose large, which is appropriate. Receding hairline looks appropriate. Wrinkles in the forehead appropriate. Man, AI is pretty damn good. The one thing it didn't do, though, normally I wear cufflinks, so the fact that it has my dress shirt with no cufflinks, flaw, fail. Anyway, let's look a little bit behind the curtain of the Bureau of Labor Statistics, BLS, numbers for CPI data. Now, I wanted to go back and dig into shows I did for Power Trading Radio for Online Trading Academy, because if you dig back into there, I've mentioned this many times, I cannot remember the guy's name. It's not Peter J. Wallison. He's the guy that told us about the housing market being rigged, which is interesting. But there was the guy that John O'Donnell brought on that worked for the BLS, the Bureau of Labor Statistics, the one that puts out the Consumer Price Index data. And so we were talking about data collection, where they get the numbers from, et cetera, and how they change it over time. And I said something kind of snarkily, is that right? Snarkishly maybe, or just kind of, I have a little cynical way of saying things sometimes. And I was like, so, do you guys, modify that data as needed? And he says, yeah, we change it to fit kind of whatever political agenda that they're trying to go after. And I was like, well, wait a minute. You're telling me you're modifying the components of CPI and really how you're tracking that data to make us feel warm and fuzzy about the data. And he said, yeah. Ever since that, I've never trusted any data that's come out, not only from China, but from US as well. I'm always skeptical about the data. However, there is no denying the reaction that the markets have to data. So let's dive into some of this data to figure out exactly what the heck went on today. I didn't... At least it shaved, AI shaved for me. Did a much better job. I have a very smooth, my forehead's wrinkled, but everything else is very smooth. All right, so here's the table of data that BLS put out. And I just want to look at it because there's only two areas that have really dramatically sold off and pulled this whole thing down. Now, what I don't have here, and I wish I did, was what percentage the weighting of this data is. So if you can look at the very top line here, maybe I can get my pen to work today. It never seems to work when I want it to work. So let's see how bad this does today. Hopefully it doesn't advance slides. Oh, okay, it's good. So the first item there, food. You notice that food hasn't changed. It's actually gone up. This is the first line right here. We're 0.2, 0.2, 0.3. We're seeing food prices continue to increase. That's what we talked about on yesterday's show. Oh, no. Go back to that. See, that's why I hate this damn tool. If you look at food at home, those prices for October surged higher, right? So food away from home. So eating out costs more money, eating at home costs more money. So those two fundamental pieces to me, like this is the one I really care about. That's what's costing me the most money right now. It's not fuel prices because I don't really drive anywhere. So that's the big stuff. If you look at food away from home, that has stayed the same, but food at home has increased. Now, the bad stuff is right here. Well, not bad. I guess you could say it's good. Oliver says, market. Merlin, you talking about the story of the manipulation them boys do to trick the markets? Yep. Look, if you look at the moves today, I think you'd all agree that there were probably hundreds of billions of dollars gained or lost depending on which way you were positioned. So if I'm BlackRock and Goldman and Citadel, I'm doing everything I can to get employees working at the BLS, right? It would not surprise me. I'd love to see some undercover documentary to show me exactly every employee that works for the Bureau of Labor Statistics. Who are they connected to? Do they have family members? Are they part of the same country club? What connections do they have to these big firms, these institutional trading firms? Because this right here was a gold mine. If you knew that this was going to come out at 3.0 today, you spent this whole week buying. You just bought and bought and bought and bought because you know it's going to come rocking up like it did today. I am. It's manipulated like to no end, Andrew. Drives me absolutely crazy. Anyway, look at the fuel numbers here. So you had energy commodities drop 4.9%. That's significant. You had fuel oil drop 5%. You had gasoline dropped 5%, and fuel oil dropped 0.8%. Great. I'm super happy with that. I'm curious how the CPI report. Curious how CPI report markets rise. I'm not quite sure I understand that one, Andrew. You're asking why did this cause the market to vault today? Because the numbers were so good. You know, if you look here on the actual chart of it, so here's your CPI. Month over month, they were expecting it to go from 0.4 to 0.1, right? A contraction. Well, we came out at 0, meaning no change, meaning inflation for the month. There was no inflation for the month. That's what they're basically saying. For the month of October, no inflation. I'm like, you had a lot of inflation. And that's what I'm showing you here on the actual BLS numbers. But when you add in the precipitous decline in energy, for example, here is crude oil. If we look at crude oil for the month of October, let's go from the first day of October to the last day. There's the first day of October right there, green candle, so it goes here to where October ended. You had a slide of roughly 12%. 12% slide in energy prices. And of course, that is a component of inflation. But you're telling me that the one that is more important, which is food, I think food is probably my number one expense. Energy, not maybe electrical, but that isn't rising and falling as much as the natural gas prices and fuel prices. So this to me, yeah, if Big Eb says end of your rally in progress, it would appear so. It would appear that optimism is right there, full force. You have PPI numbers coming out tomorrow, which we'll talk about in a little bit. But what I'm hopefully conveying here is we're seeing some things drop. Look at electricity. Electricity went from 1.3% increase the previous month to 0.3%. So we're definitely seeing prices decline there, but food being stubborn and staying high. It's the energy costs that are really the major influencers on the CPI data, at least for the month of October. Of course, we'll know what happens for the month of November here next month, but so far, only one real segment of this is showing steady declines. Look at pipe gas services. Well, that increased 1.2%, so that's not a contraction. Now, if we go to one page further, this is where you look at everything other than food and energy. Okay, so I look at commodities and vehicle sales and shelter, meaning rents. They're saying that shelter prices have gone down. I call it absolute BS. I am not seeing rental properties decline here. I'm not seeing housing prices decline. They're actually going up in my neighborhood, but it shows a significant drop over the previous month. So if you go from September to October, it went from 0.6 to 0.3. Year over year, though, it's still 6.7% for the trailing 12 months. That's pretty bad considering the Fed is targeting 2%. Which pieces helped the numbers this week or this month? It's right there. Right there's your little negative ones. You had the contraction overall for commodities when you take out food and energy commodities. Really, used cars and trucks was the real big piece that brought this down. I thought that was kind of funny. That's the major decline that was happening there, but it's actually slowing down. Because the previous month was a 2.5% contraction, and we only had a 0.8% contraction. So that's starting to move back to the upside. So I will show you the other charts here for CPI numbers. And let me get that one. Here is your CPI year over year. When you look at the number that came out today, right? When you look at the reaction of the market, I mean, hell, the Russell was up 5%, peeps. I don't know if you saw that. Let's take a peek at the Russell 2000. 5.47% pop to the upside. That's a God candle. Going back to our crypto terms, I mean, that is a ridiculous move to the upside there. Thank goodness I didn't have any of my short positions, but I'm kicking myself because remember, we were talking about going long right here. We basically, on October 27th, rewind the show, we said this is a good place to be going long because you're right near the bottom, and I'm kicking myself that I didn't go long that one. As you know, I went long the NASDAQ, but I sold out 2 days later. I went long here on the Friday the 27th. I sold out at the end of day on the 31st, and man, the market, since I got out of that long position, I was a pretty big one, the market's up almost 10%. Can you imagine how significant the gains would be on a leveraged position using options if you rolled that whole move? Yeah, well, shoulda, coulda, woulda. In fact, I lost money on this one trying to short this thing as it rallied back up into supply right here. This is a pretty good loss for me. But all in all, it just looks like it wants to keep on running here. Optimism is pouring into that NASDAQ, and we'll look at those ones here in just a second. Let me read through some of these comments. Lisa says, Ken Griffin said he does not expect a recession in second quarter of 2024. He was interviewed on Bloomberg this afternoon. He does expect. I just don't think that it's done, right? We're seeing a complete overreaction, in my opinion, to a CPI number that shows inflation staying pretty much where it's at, not declining. We're staying where it's at, which is fine if you do the trailing 12 months. But I still don't think that we're out of the woods yet. I think you're looking at a situation where there's a lot of pressure on commodity prices, particularly crude oil, with political involvement to get that down. But, I mentioned one of the reasons I went long on XLE is I expect there to be more of a flare-up in the Middle East. I don't see that everybody just standing aside, letting it all pan out and letting Israel do what they want to do. I can imagine a lot of the Muslim countries having a little of an issue with that, especially the lengths that they're going to. And I just thought that would be a bigger flare-up. So I've been wrong to this point. Actually, I haven't been wrong. My XLE is doing fine. Those put positions are expiring. When did I say? Did I say the 8th? I think they're the 8th of December. Maybe that was the Fortinet. I got a bunch of positions open. So it's always a good time to hit that like button, Sly. Thank you for that one. I moved my stop to break even on Bitcoin yesterday, too. Yeah, I'm keeping mine forever, Brian. I don't need to stop. That one, I'm good. What did I ever say? Merlin, S&P 4,500 by year end, you think? Well, we're at 4,500 right now. I don't know. There's so many arguments you can make for either way. Right now, though, the enthusiasm and the momentum is without a doubt. If you're to go off of what's happening right now, momentum-wise and optimism, we'll be breaking all-time highs here in no time. If I look at the data itself and the impact of data, the impact of rate cuts, and the bond market, to me, that is not saying that's saying that we won't be higher than 4,500 by the end of the year. But there we go. That's I don't know. I have very light positions, so I don't have anything really heavy. As you guys know, I sold a whole bunch of puts a couple weeks ago. Those are going to expire this weekend, so a bulk of my capital is tied up in puts that I sold at. I'm not worried anymore because those are so far away from hitting my strike price. It's great. The only ones I'm a little concerned with in my current portfolio, not concerned, is silver. All right, I have some 22 call options and 22.50 call options expiring this Friday in my account. And of course, when it jumps 3.6% like this, was a beautiful day for my silver portfolio. And I don't really want to have my silver taken away, but I don't think that we're going to get to 22 by this Friday. If we do, it's great for me, right? It's not like I'm going to be crying. It's going to be great. I've made a ton of money on the silver position, and now I just have to figure out how to redeploy my capital. Actually, starting this Friday, once the markets close, now I got to go do a bunch of analysis and kind of see how I want to reallocate things because the markets have moved up so much. I'm not going to be, selling calls. I don't do that. That's too risky for me. So I'll have to wait for some market to prove itself and look for opportunities that way. Let's see what else we got. Will the president elections affect the markets? Absolutely, Robert. You betcha. Boy, howdy. In a big way. They always do. Typically, election years are bullish years. So, take that for what it's worth. We'll see what happens in 2024. For this, right now, I'm just not worried, but I'm focusing on the next 2 months. Right, November, December. I just have to look at what's in front of me right now, and I'm starting to want to pull my trades back to shorter terms, kind of go a couple day swings here. I've been kind of setting up some longer swings over the past few weeks, and they've been getting burned, particularly short stuff. So we'll not worry about the short trades anymore and look for those long ones. When was the market this crazy up before? Some people say it is because the institution is trying to make data look good in year end for their funds. Yeah, that is certainly. I think it's a little too soon for that. I think it's too soon to say that this is institutional movements pushing it up. This, I think, is predominantly data-driven. If you look at right now what the hypothesis was, and let me go to a question here from Les. Let me just bring this up real quick. Les asked, he says, on the CME FedWatch tool earlier today, at a 100% chance of no rate increase, and the same for the January meeting. The March meeting also showed a chance of a rate cut. Does this indicate that the Feds might be finished raising rates and maybe reducing them? Would this cause a year-end rally in the market? 100% less. If I had a nail-on-the-head graphic, that's exactly why this market did what it did today. If you looked at the Fed funds probability for, let's say, next summer, get into July, August, that's when there was the belief that we're going to start to have rate cuts. But because the inflation number today was so optimistic, it has almost every institution and most retail traders going, oh, this is done. We're not going to have any more rate increases. Inflation is done. It's defeated. Therefore, the prospect of rate cuts won't be coming next August and September or July. Maybe we might see them in, February, March, way earlier than planned. And I think that's why you're seeing this surge up, is people going, uh-oh, I want to make sure I have something in my portfolio when these rate cuts come to fruition. So let's go and look at that real quick here. This is the forecast, or the trades for the December 13th meeting. And you can see right now, 99.8% chance of a pause and no rate increase. Now, if you look at what it was yesterday, there was a 14.5% chance that we're going to see a raise in December. And now it's 0.2%. So that's why you saw this market surge. It's the belief that the Fed is done raising rates, that this is it, we're over. If I go to, let's say, January's meeting, you guys notice that there's still a 0.2% chance of an increase, but pretty much everyone's expecting it to stay the same and maybe start to drop. As we get further out, let's go to, like you mentioned, May here. Now all of a sudden, you're seeing the general consensus is we're going to be lower. A 49% chance we'll have a 25 basis point cut by March of next year. As of yesterday, that stood at about 30%. So we've almost doubled increased 20% the probability of a rate cut by next May. And this is why you're seeing these markets rip like this. So yeah, you're 100% right. It's the belief that we're done, that we're out of the woods, that it's all smooth sailing from here. I personally don't believe that. I just personally don't believe that it's that this is it and we're done. There's just too many factors, I think, that are just going to slow things down. I'm not saying the market's going to crash. I'm definitely not saying that. But I do think that there's going to be a slowdown overall, and I think you're going to see those markets drift lower. But so far, particularly since the month of November, I've been dead wrong, right? Which is fine with me, because my September and October trading months were phenomenal. I'll take a little bit of loss here in November, but definitely starting to slow things down, because I've had a couple stinger losing trades, particularly shorting that triple Qs, that I don't want to give back a lot of my gains. So I'll slow it down here until I get a much better feeling about where the markets are going to be headed. And I just can't, for myself, I can't put myself all in on the bullish position right now. I'm happy to sell puts at levels much lower and buy dips if they happen and collect that premium. But right now, I don't know. I think this is fake. I really do. You look at what happened to that NASDAQ. I mean, look at this chart. This is ridiculous. From those dead lows. Remember, the average annual return for the S&P is 10% per year. From dead low to peak, you're up almost 13% in 13 days. Come on. That's ridiculous. Anyway, it's a trap. Admiral Akbar, it's a trap. Yeah. Now, and look, I'm happy for those of you who are out there making money on it. Great. If you're long right now, God, today was a hell of a day. Monsters, particularly if you're long on that Russell. Like I say, I've sold puts on Fortinet, I've sold puts on XLY, I've sold puts on XLE, I've sold puts on SLV. So I'm definitely capitalizing on this market rally, but not to the percentage gains that I would like to be getting, especially because this market's been moving so aggressively. Just absolutely phenomenal move. So with that, let me run through our top 7. This is probably the big story right here. And you guys know from my talks with Bill Addis, who I trust implicitly with his bond knowledge. I think that he is one of the smartest people I know, particularly in bonds. You look at this pattern right here, this doesn't bode very well. A friend of mine asked me if I thought this was a head and shoulders pattern, and I don't know if I would necessarily call this a true head and shoulders pattern, but remember, head and shoulders pattern tells you a couple of things. If we were to draw these lines, I'll draw them all in blue. Give me a second as I draw this out. So for those who don't know what a head and shoulders pattern is, maybe this will help you. If this is the left shoulder and that blue sloping down line is the neckline, then what you have is, you can do it here. And that's the picture there of the head and shoulders. We're at a point right now where some people are believing that this is going to break to the downside. And we saw this come to fruition on the Russell 2000. It actually hit perfectly. If that's the same basic thing, then we look at this measuring object, which goes from the top of the head and shoulders to the neckline. I move that down to here, and that means that we should be looking at about 3.95% yields for the 10-year. I'll leave these lines on here just to have them there. And again, if you believe this, then you could be making trades based off of that. I personally don't think we're going to get there. I just definitely don't think we're going to. It's the Quasimodo one. I like that, Brian. It is. It's kind of a funky one, but, what does the picture say? Remember, a head and shoulders tells us, I'll drag it so you guys can see it. right here, this is not a head and shoulders. This is an uptrend. This is what if you want to be an Elliott Wave practitioner and call it a 1, 2, 3, 4, 5, fine, whatever stage you want to call it. This is bullish. This is still bullish. This is still, right here is where it made a little bit of a negative piece because it broke those lows. And for those that listen to the podcast, I'm talking about the low on November 3rd was lower than the low from October 12th. So that's a slight break of the trend, right? It's no longer making a higher low. That was negative. But you're okay, we'll wait and see what it does when it makes its next high. So it rallies up, and then all of a sudden it can't make a new high. This is where all of a sudden it becomes extremely bearish. Today's action like that, really aggressive to the downside. Now, if you are a head and shoulders fan, as I am, then that would lead you to believe that we're going to see these yields drop much lower. Let me ask you this. Why would we see the long end of the yield curve drop so much today, right? What would cause, and type whatever you guys feel, I mean, this is a little class right here. What do you think would cause the market to price bonds down 4% and when the yield dropped 4% today, right? We went from a high of, 4.64 to we're now at 4.45. That's 20 basis points in a day. What would cause the long end, that 10-year, to drop like this, right? There has to be some reason why people are all of a sudden buying up those 10 years and therefore yields are dropping. Why is that? I'll give a second here for those to type in a chat. Actually, that was a Josh. I told you it was be. Nobody? Anybody? Too much supply? Well, we certainly have a ton of supply. Remember, if you have a ton of supply of bonds, that actually drives yields up. Because if you have so much supply and demand stays the same, then you run out of buyers for it. So you have to pay a higher yield to entice them in. So I got a couple things. Good. I love it. Robert says the dollar dropping. That's a part of it. August says CPI numbers. Shinobi says rate cut expectations. That's pretty much it. So let me see here. Let me draw the yield curve, right? Let me bring up my PowerPoint here. We're going to go live lesson with my wonderful drawing tools, and hopefully it works. So where's Les's comments there? I'll insert a slide. One sec, as I got to get my drawing tools all ready for you guys so I can create the graphics. There we go. We're going to make that a white slide, and here you guys go. Okay, so I've got a blank slide right here, and here's really Oliver says cooking the books. Yes, that's probably the real answer. Let's go look at a yield curve. There we go. So we'll go do normal. Right, a normal yield curve, right? This is going to be your, let's call it 3 month. You got your 1 year, 5 year, 10 year, 30 year. I know these aren't proportional, but typically what you get with a normal yield curve is it looks like this. The longer you commit your money, the higher rate of return you're going to get. So let's say that this is, 4%. Oops, why did that disappear? Let's say this is 4%. Well, this might be something like 6%. That's normal. Inverse would look something like this, where we have rates dropping over time. So let's say this is 4%, and now, wait a minute, the long end is like 3%. That's a broken system. And this is where we are now, right? We are right in this situation where the longer term is less. So why would all of a sudden we see these yields drop really sharply? Well, the main reason is, if we look at where we're at right now, here's your 10-year, right? And the 10-year was at, let's call it 4.6, right there, and then it dropped to 4.4. Why? I mean, the whole thing shifted down. Well, it's because the expectations are that this other end of the yield curve, the short end, is going to be dropping. So right now, let's say we're up here at 5.5. Oops. The belief is that number is going to be dropping. You saw the rate cut expectation starting in middle of next year. So if all of a sudden we get that, we'll be back to a normal yield curve, but the expectation is that all those other maturities in here are going to start to drop, that they're going to get cut. Now, that's one of the main reasons, right, is that we're going to see the short end of the yield curve drop. The other part here is this. I mentioned this many times, and this is to me one of the main components of retirement planning. If you are about to retire or nearing retirement, you should be looking at your numbers and saying, it's not a question of, I have $1 million or $5 million or $100,000 in my retirement account. To me, that's not relevant. What's relevant is, how much money do I need every month to survive in my retirement years? Omitting Social Security. Just delete Social Security from the equation. If you get it, great. If not, let's pretend you aren't going to get it. But let's say, for example, you assume that in 30 years your home is paid off, so you don't have a mortgage payment. You'll be paying property taxes and insurance. Then you have your food and your healthcare costs, right? And your lifestyle, if you're a golfer, price all that in. So let's say that my total living expenses are $5,000 a month. The key to retirement is saying, if I need $5,000 a month, then I need enough money now to earn me $5,000 a month. And bonds are traditionally a great way to do that. So if I know that I need $5,000 a month, then really all I need to do is take $1 million and buy the 10-year right now, because I can lock it in for the next decade at 4.6%. Well, I could have yesterday. Today it's now 4.4. So what you get are a lot of people that are looking at the future thinking, bond prices, bond yields are probably going to drop going forward. If that whole short end of the yield curve shifts down, that whole piece drops down. And because it drops so much, the belief is now that the 10-year will start to come down as well. And therefore, people are locking in that yield. They're trying to buy the long end of the yield curve to lock in a rate of return for a longer period of time. And in doing so, demand increases significantly for the 10-year. And now, all of a sudden, yields drop. Prices of the bonds go up, but the yields of those go down, if that makes sense, right? That's really the big picture. Aren't there super large short positions on the bond markets too? Yep, I'm sure there's short positions all over the place right now that are getting smoked. I mean, today might have been a short squeeze for a lot of markets, man. A lot of people getting killed. My company said they entered a position today based off the 30-year, 5-year steepening, assuming they're going long on long bonds or utilizing the futures market going long the ZT or maybe a spread trade. You got a pretty savvy company that's trading your positions like that. Are you in the financial markets? I'm hoping this isn't just your company's 401k and they're disclosing the transparency like that. Look, I think a lot of companies, particularly annuities and things, are jumping on that bond market because now they can lock in a fixed rate of return on government bonds, which are about as safe as you can get. Even with the downgrades by S&P and by Fitch, and Moody's probably coming up in the next few months, we're still one of the most stable bond markets in the world. So, that's your data. That's why I think you saw the bonds sell off so aggressively today. Bond yields sell off so aggressively today. When we look at this picture, that's definitely an argument for the markets going forward for this to go even lower. I'm still skeptical on it. I definitely am. That this is based off a huge assumption that the short end of the yield curve is going to aggressively be cut. I think it's going to take some time for that one to take that time for the short end to drop as aggressively as I think is priced in today. So I actually expect these bond yields to bounce back up a little bit. Not saying to go back to those highs at 5% quite yet, but I do think you'll see them bounce up. I think today was a bit of a too big of a knee-jerk reaction to the data, and I think I mentioned that algorithms are a huge factor in the markets. And as you have a bullish day like today and everything looks really optimistic, the buying felt like it was almost nonstop, particularly in the morning. When you look at the 5:30, for those of you who might be pre-market people, let's go and look at the NASDAQ pre-market here on a 5-minute. I say pre-market, before the official open. Notice right as that announcement came out, there was an instant market move. And remember, the markets aren't that liquid at that time. You saw a 1.25% move in 5 minutes for the entire NASDAQ. Phenomenal. And then, you saw that buying going on for the first couple hours of the day, and then we kind of just went choppy. And I bought 5 directional puts on triple Qs today. Just 5 as a little bit of a test. And I bought the 380 strike expiring Friday. Aggressive. I will probably close it out tomorrow. I do think that the PPI number is not going to be as good as CPI, but I didn't want to take a big chance at that one, so just a few $100s worth of risk on that one for me. Yeah, it is. It's Movember. You know what? It's funny because I have the worst facial hair on the planet. It's just all patchy on the sides. My good friend Todd from NorCal. It's funny, everybody thought we were brothers for the longest time. This right here, what I have is he is literally one day. This is what his facial hair is like. This has been since November 1st. We're on 2 weeks here, and I don't know how guys can do the full beard thing. It itches like crazy. It drives me nuts. How does the current increasing in government spending could affect those bonds? Yeah, GS, that's where I'm torn. So when you look at what's going on with government, I talked about yesterday's show was about that, right? What's the bond problem that our government has? They need to fund with so much more debt. This actually helps them, right? Because they can now issue new bonds at a much lower rate the faster these things drop. So, the lower yields go, the better it is for the government to service all this debt. But it still doesn't fix the problem, right? It's like you're still addicted to drugs, but the drugs are cheaper, so you can buy more of them, right? That's kind of the analogy. If yields drop, does that fix our problem that the government has? No, the government has a spending problem. We need to rein that in. We need to fix the spending problem, and that's tough. Every person in here is enjoying the fruits of that spending, whether it's parks, services, just things in general. Watch when those cutbacks come. We're all going to be upset that they cut this and that's no longer. Right. We're going to be upset about some of those cuts, but you can't have it both ways. You can't enjoy all this spending and just it's like having a buddy of yours who is always buying all the dinners and food and everything, and you realize he's really bankrupt and he stops buying. You're like, oh man, Kevin's not buying anymore. Shoot, I got to pay. Yeah, well, that's going to be a little bit of a change here. I'll see what I can do with the mustache and the goatee going forward. Am I using regular trading hours and trading view? I do both. Depends on what I'm looking at. So these are RTH right now, but if I go to ETH, you get the extended trading hours. So I was looking at the when I looked at pre-market, I was looking at the futures market because it's much more liquid. So there's the chart there. Yeah, when I look at anything that's a stock, and I want to see the pre-market hours, yeah, I absolutely do look at the ETH, the extended trading hours. Obviously the picture is very different when I look at this versus this. And one thing I definitely like to look at is liquidity, because you can see the volume that happens when those announcements come out. Notice the volume that happened when that announcement came out for the triple Qs. There really wasn't much buying that drove this up so much. It was actually fairly minimal considering how much was there in the opening bell. All right, let's see what else I had. Let me just go. Any other questions on that? The original topic for me for today was just this, the CPI data. It looks great, but it smells fishy in my opinion. It really feels to me like this is based off of one particular thing, right? It feels to me like this is based off of energy predominantly. Have we seen the other commodity markets sell off? We actually have. I'll be honest. The month of November, let me put this on a monthly time frame so you guys can see some of the other commodities here. And I don't have all of them, but just so we can see what the previous, God, look at the month of October. That's crazy. We've erased 3 months of sell-off in 1 month, and it's not even done. Anthem says, why do you use the yield chart instead of the price chart for treasuries? Always confuses me. Well, because when I go to buy a house, nobody says, hey, we're trading at 356. That doesn't mean anything to me. When I sign a loan, it's for a yield. I want to know what the yield is, because there's a bond yield curve. There's not a bond price curve. So if you're a trader, yeah, you're going to be trading the underlying futures, but I want to know what the yields are. Right? The yields are what are more important. As time goes on, those yields are the ones that are moving the markets, not the bond prices themselves, right? As someone who's buying and selling something like a bond market like TLT, for example, I could quote you the price of TLT, but if you were buying or selling TLT, that becomes very relevant. But that's just the price of one instrument, TLT. For me, it's more important to know exactly what the yield is of those bond products. In this case, the 10-year, watching this yield move up. This is a tradable instrument for sure, but what it really does for me is it tells me this is choking the economy. When you have yields down at 4.4% back in March of 2020, and here we are 3 years later hitting our heads on 5%, that obviously is going to be a big negative piece for our markets going forward. So that's why I use the yield chart. I like the yield as a broader market soothsayer, if you will, much better. So let me go look at just a couple of these commodities, because again, that was cited in the CPI report today. You look at something like cotton. Well, the month of October, sure, it was a negative month, but how negative? Well, 7.4%. All right. Want to look at something like soybeans? Soybeans were up for the month of October. So I've got 1 and 1. Corn futures, pretty much unchanged for the month. Now, what we saw back here, if you go into November of last year and we had some massive declines for cotton, particularly back in June of this year. Man, crazy declines there. But that CPI report for October did not really have any impact with cotton. How about wheat? Right, wheat was up for the month of October. How about lumber? Lumber down slightly. Natural gas. Well, natural gas was up significantly. So I question where a lot of this data is coming from. How about sugar? Sugar ripping to the upside. I mean, this monthly chart of sugar just makes you think about, pretty soon this is gonna be like a can of gold right here. I got a Dr. Pepper in my hand. You know how many grams of sugar in this thing? 39 grams of sugar, which is crazy because there's only like 50 grams of stuff in here, and 39 of them are going to be sugar. Pretty crazy. Orange juice. Oh yeah, orange juice futures are nuts. I don't have that on my list. It won't let me add any more, but let me go to orange juice futures. It actually had a pretty significant sell-off here, but let's go to this continuous contract here. Yeah, that monthly chart of orange juice is just jaw-dropping. We'll go back to these lows of 2020 to the peak here. You're talking a 333% rise in the price of orange juice. This is like a Bitcoin price chart. And people are like, oh, Bitcoin's volatile. Yeah, OJ is too. Holy cow. But notice the daily on this one. We've had a lot of volatility recently. I mean, there was a 4-day run where orange juice fell from its peak. It hit lock limit down a couple of days. Almost a 17% slide in 3 trading sessions. Phenomenal. But yeah, I don't know. I'm skeptical. I know you guys probably think I'm a perma bear. I'm not. When the market tells me to be bullish, I'm definitely bullish. But it just really feels like, I don't know. I just don't see this data point other than looking at crude oil, which is what I think the basis for most of the month of October. Let me get rid of these lines here. And we'll just pull up a monthly candle. This is the big news. This is why we saw, I think, CPI drop so much. It's really because we had a decline of 11%, roughly 11% in gas and oil. So that's your main reason. Anyway, I'm not sold on it. Not sold on it. That more than a Snickers bar. Exactly. Sugar going up tells me Americans will get even fatter and more unhealthy. Yeah. Are you trying to make me feel bad about the need for my Dr. Pepper this morning? Just so you know, I do have a bottle of water next to me just so I can offset the sugar intake and dilute it. Yeah, Lisa, I agree. The data is convenient. But remember, my job isn't to believe, disbelieve, or whatever the data. My job is to make money as a trader. And it's been difficult. It's been difficult because I'm looking at the numbers, and the numbers tell me something's a little fishy here. It feels like we've got 1 point data. Because oil has fallen so much so quickly, it's skewed that data. Keep an eye out. If we get another, a surge up, if Iran gets involved, and all of a sudden you see oil prices surge, and you can expect that next month of CPI numbers to be higher than expected, and therefore markets sell off because commodity prices have risen. Again, the soap opera continues. So we'll really be keeping an eye. I'll be keeping an eye on crude oil for the next couple of weeks, and anything that disrupts crude oil and causes that to surge again, I think will be reason to go short these markets aggressively, because right now it feels like crude oil has been the piece that's been helping them jump to the upside and give the illusion that inflation is defeated and under control. Mike says, I'm thinking of getting a new computer. Should I consider a gamer computer with high-end graphics? Nope. No, you shouldn't. What you should do is you should build your own. We're actually pretty easy. So I built a custom computer for this to broadcast from. Triple monitor setup, and it cost me $1,200, and it's probably better than any store-bought gamer computer you're going to get. There are certain things that you need and certain things that you don't need. And I think if you get a gamer computer, there's maybe some components in there that you're paying extra money for that you don't need. I actually look back, Mike, if you go to the TraderMerlin YouTube channel, you click on the YouTube channel, I'll actually show you. I'll walk you through it right now just to help out. Let's go to TraderMerlin. For those who might be new, you just go to the TraderMerlin. It's right here. And then I think if you click the little search icon right here, I think it'll allow you to go, if you type in computer, I think there's one where there, build your own trading computer. I did this, it's 3 years ago. Oh man, that's an old one. Oh, there's a newer one with the AI graphics. So I will copy this over and throw it in the chat for you. Should I set file a copyright claim because I'm playing my own show on my own channel? Anyway, that's the show right there. Check that one out. That should help you out to build your own computer. Again, markets are going to evolve. I'm going to need new technology. I'll need some new things, but in general, I'd say build your own computer. That way you're more intimate with the components. You understand what you're doing. The toughest part is making sure that the motherboard that you select fits the processor and all the different components that you want. In that video, I talk about a thing called a PC part picker. It's a website you can go to that will tell you the compatibility of all the components. You just buy all that stuff, you click a button, it's delivered to your door, you put it together. The toughest part is putting in the operating system. That takes a long time. It's kind of a pain in the butt, but I think you'll be better for it. It'll take some time to get it all done, but I'd rather build one. If you can't, then yeah, get a gaming computer. Long story short, if you can't do it yourself, buy a gaming computer. What's important here is to understand which programs you're using. So if you're using a web-based platform, nowadays I'm pretty much using all web-based platforms. What you want to make sure you have a lot of RAM. RAM is key for web-based projects. If you're looking for a downloaded, installed application, you want to have a much more robust processor to handle all the stuff that's on your computer. But if it's just browsing, get yourself 32 or 64 gigs of RAM. It's $100 or something for. It's cheap. RAM is cheap. Get a lot. Chris says, who regulates the market? The SEC. They're one. There's FINRA is one of the major regulatory agencies. You also have the CFTC, Commodity Franchise Trading. You have several different agencies depending on which market it is. But the SEC is kind of considered the big dog, the peak of the pyramid. But regulates the market. I guess I would say, which market are we talking about there? Each market's going to have their own regulatory body. I like my Lenovo laptop. Great customers at Lenovo's. Yeah. A Hive operating system on it. See, I've got some PC fans or some Mac fans in here. I'm not a Mac guy. I don't like Mac. I don't like Apple, period. I think they've done too much to keep everything closed off and give Apple all the power. I like Microsoft's more open approach. You want to build something? Come on in. Let's have some fun. So I'm more of a PC guy, but hey, to each their own. One thing to keep an eye on is if you are using a downloaded software application from your broker, just double check to make sure that it is compatible with a Mac. For years, most applications didn't work with Mac. Now most do, but always check. If it's something that you're going to download, make sure it's Mac compatible if you have a Mac. All right. Yeah, I would much rather have Linux. I would have Linux, but I don't know much about Linux and coding, so I just went with old Bill Gates. Got to support Microsoft and their all-time highs. All right, I'm at 43 after. Let me get to this one question here. So Lisa says, this isn't what she was waiting for the SEC approval on, correct? Or is it? I see BlackRock is still waiting for the SEC approval. So there is 21 Shares is just a company that is partnered with ARK. And it sounds interesting. You're crypto native and active managed ETFs. So they came out with these new products. You've got the ARK 21 active Bitcoin futures strategy, the ARK 21 shares on-chain Bitcoin strategy, ARK 21 Bitcoin Ethereum strategy, the blockchain. None of these are what the SEC is waiting for or what the companies are waiting for, right? This is all done in old hat. If you look here, ARKA, right? That's the ARKA Active Bitcoin Futures Strategy ETF. That's the same thing as BITO. It's the same thing as BITO. It's just a futures ETF. So who cares? I wouldn't touch it. Same thing with this one, ARKC. This is an active managed Bitcoin ETF using Bitcoin futures. So they're all using Bitcoin futures. There is no spot holding in any of these. What they're really waiting for, she is Kathy Woods. Excuse me. Sorry, my bad. What everyone's waiting for is a spot Bitcoin ETF. All of these products that ARK is looking at and rolling out this week or next week, they're all based off of futures products. You don't actually own anything. There is no ownership of any Bitcoin anywhere in that process. The spot Bitcoin ETF will, now if let's say ARK gets approved for a spot Bitcoin ETF, that means for every Bitcoin that someone buys worth of Bitcoin out of their fund, they have to buy a Bitcoin. So, I saw somebody in here saying, I want to buy a full Bitcoin. If you were to buy a full Bitcoin from any of these spot ETFs, they have to go out and back it up with a full Bitcoin. Aha! And that's why prices could get much, much higher. Can you get Steven Van Meter back on your show? I can't. I have asked him. He said he does not want to come on my show. Bummer. I like Steven Van Meter. He's good. But yeah, I asked him a couple times and he said, I don't have the time and I'm not interested. So it's like I got rejected. It hits me right here. So if you know him, Tim, ask him. I'd love to have him back on. He was great. Good guest. Interesting perspective on the markets. Like talking to him. So to Lisa's question, this is not what BlackRock and everybody's waiting for. They're all waiting for a spot ETF. These are just packaged products that incorporate the current futures market, because there's Bitcoin futures and there's Ethereum futures, and they're using those strategies there. So that's pretty much all it is. Okay, that's going to do it for me. Is that the crazy bond dude? Yep. That's the guy that calls himself the bond king, where I think that Bill Addis is the bond king. I think Bill Addis knows more than anybody about bonds that I've ever met. So anyway, let me see. What do we have for our economic calendar for mañana? Of course, as I mentioned, we do have a big day tomorrow because CPI was today. Oh, the kissing cousin is tomorrow. That's going to be PPI. Producer Price Index comes out tomorrow morning, same time, 1 hour before the markets open. Right now, the expectations are it's going to come out in line with the previous month. You can see it right here. Well, given what happened with CPI, it's kind of funny. They expect CPI to drop significantly, but they expect core PPI to stay the same. It would not surprise me at all to see this number come out lower than expected. I mean, the table was set right here. Right? If you look at month over month, they expected PPI to drop. They actually expected core to stay the same. So it's weird. They don't have a regular PPI. They just have core PPI. Stupid the way they don't report these things. So they actually did have a core PPI staying the same. My guess is you will probably see core PPI drop to probably 0.2 tomorrow, maybe 0.1. We will see, but probably 0.2 would be the number I'm seeing. Anyway, the big news is going to be the PPI numbers. But you also have retail sales, Empire State Manufacturing Index. Those are all coming out at 5:30. That's 1 hour before the equity markets open, so careful for that one. If you are trading crude oil, you have crude oil inventories as well as business inventories. Busy day for the U.S. markets. If you're trading the Australian markets tomorrow afternoon, you have their unemployment rate as well as their employment change data. So there you go. And then, let's see, that was your economic calendar. I guess you probably want to know if there's any earnings calendar information coming out. We really didn't have anything big today. The only thing there was Home Depot. They beat earnings. They're up 5.4%. Great day to beat earnings when the markets are surging. But here's what's cooking for tomorrow. You have Cisco, Target, JD.com. You have Palo Alto Networks, TJ Maxx, Advanced Auto Parts. So a lot of retail companies reporting tomorrow. So keep your eye on that one. And yeah, that'll be the excitement for tomorrow's trading. That said, I think I got all your questions answered. I think everyone's done. So hopefully you guys had fun, enjoyed something today on the show. If you did, hit that like button, share it with some friends, subscribe if you're new, and send me questions you have, and I'll make that the show for tomorrow. TraderMerlin@gmail.com is the email there, so send it on in, or put your comments down below any of the videos on my YouTube channel, and I'll get to all those questions on tomorrow's show. Take care, everybody.